Good afternoon, good evening, and good morning, friends. And today's episode, let's go through the some of the basic problems and solutions what we have in textbooks. Our idea is to give the students a heads up on how to solve the problems and understand how the solution has been arrived at. So I have taken the 11th standard accountancy textbook. You can see here accountancy volume 1, and I'm in chapter 3, 3.8.6 analysis of transactions. So let's go through the journal entries and how that has been prepared, because when we go into the next chapter of ledger, as I said, that we have to understand how the journal entries are prepared and what is the basis of these journal entries, why this account is debited and why it has been credited, etc. Right? Let's take the first transaction. Somu commenced printing business with cash 50,000. So the journal entry for this will be cash account debit, capital account credit. Why cash account is debited? Because we have seen like cash is an real account. So the rule of real account is debit what comes in. So here in this case, cash comes in. So cash comes in and we are debiting cash account. Let me make it smaller. Then capital account is always a liability account, always a credit account, credit balance account. We saw that in the earlier episode. And capital also, because Somo is bringing capital, it's a personal account. So rule of personal account is credit the giver. So that is how cash account debit and capital account, Somo's capital account is credited here. You can see the journal entries, cash account debit and 50,000 to Somo's capital account credit. Next example is bought goods for cash 4,000. So bought goods for cash 4,000. What is happening here is we have bought cash. Let's take purchase account debit and the credit will be to cash account. Why credit is cash account is because it is goods has been purchased for cash and cash is going out. Credit what goes out. Why purchase account is debited is because purchase is a personal account and debit what comes in. Sorry, purchase is a nominal account and debit all expenses and losses. So that is the reason debit all expenses and losses. So purchase account debit and cash is going out, so credit what goes out. The third example is purchase goods from Rahul for 10,000 on credit. This is interesting. So you have to debit purchase account here and credit Rahul account, because it is a transaction on credit. And we saw that liability account is always will have a credit balance, and Rahul being a creditor will have a credit balance. More so, why we are crediting Rahul account is Rahul again is an personal account because it is a natural person. So the rule of natural person is credit the giver and debit all expenses and losses. So purchase account is debited. Next example, cash paid to Rahul for 4,000. You can see here example 4, cash paid to Rahul 4,000. So debit the receiver, Rahul account debit, credit what goes out, cash account credit, because Rahul is a personal account. and cash is a real account. The rule is credit what goes out, and here debit the receiver personal account. That is how it is debited to Rahul and credited to cash account. Fifth example is withdrew cash for personal use. Cash is withdrawn for personal use. Okay. Drawings account debit and credit what goes out? Cash account credit. Why drawings account is debited is drawings again it's a personal account. So debit the receiver. Drawings is the owner of the company is withdrawing cash. So when he or she withdraws cash, obviously it's a personal account being a real person and an artificial person. So debit the receiver and cash account is credit what goes out. So cash deposited into bank. This is interesting. You can see here next account. Example 6. Cash deposited into bank account 5,000 rupees. Here bank account debit and credit cash account. Why bank account is debited is again we have seen bank is a personal account, so debit the receiver and credit what goes out. Cash deposited into bank account debit cash account. Seventh example is paid salary by check. Paid salary by check. So salary account debit all expenses and losses. So it's a nominal account and debit all expenses and losses is the rule and salary paid by check. So bank account credit. When we pay by check, obviously the cash money will go out of bank and bank being a personal account and the rule is credit the giver. Is it clear? Any doubts or clarifications on this first 7 examples? Please put it in the comments against this video and I'll come back to you with clarifications if any. Thank you friends.